So, chapter number 11, variance analysis. Now, this chapter is very basic and really, I would say, easy compared to the other chapters we have done so far. So, variance analysis is just to find the difference between the actual and the budgeted. So, basically, what was the plan and what was the actual result. So, if my plan was something and the actual outcome, if it is better, then it is good for me. So we called it a favorable variance. If my plan was something and if the actual outcome or if the actual result is not better or even not good than that, so if it is worse than that, then it is a adverse variance. So basically, when we make a plan, let's say we said like this pen, the plan is I'm going to make a sale 100 pen for the month of, let's say the next month will be March. So for the next month, I made a forecast, I make a plan, or I made a budget. The next month, I'm going to sell 100 pen. And unfortunately, if I sell 90, so that is less than 100, that will create the variance. So that means my plan was I'm going to sell 100, but I have sold only 90. That I will be find out next month, end of the next month. So if it is less than my plan, then we called it adverse variance. So that is basically less than my plan. And if I can sell more than that, for example, my plan was I'm going to sell 100 pen, but if I can sell 110 or 105, so I have sold more than my plan. That is called favorable variance. So one is adverse variance. Variance is a bad for the company. On the other hand, we have favorable variance that is good for the company. Now, adverse variance always reduce the profit, and the favorable variance always increase the profit. There are certain conditions that we also have to know when you prepare the variance analyze, especially when you do through the flex budget. So let's have a look what we have on the chapter overview, and we'll discuss more from there. So in this chapter overview, we can see the first one, they said traditional variance analysis. So traditional variance analysis, we have original budget, that's my plan. Then we have a flex budget and we have an actual result. Now, more or less everyone, we understand original budget means my original plan. What is the plan? And the actual result means what is the actual outcome. So we understand that very well, but only maybe we are not very used to with this flex budget if we never done it before. But if you already done it in your advanced bookkeeping paper or something from this paper, then we already know what it is. If you don't know, I will explain a little bit for that as well. So the flex budget is the budget that change with the activity level. We have done few questions before, but if you just try to remember it, you will remember flex budget is the budget that will change based on the activity level. So based on the actual outcome. For example, let's say if my plan was in 1 hour I'm going to make 10 pen. In 1 hour I'm going to make or I'm going to produce 10 pen. But in 1.5 hour, let's say in 1.5 hour, I have made I have made 20 pen. So normally my plan was in 1 hour I'll make 10 pen, but in 1.5 hour I make 20. Now, if I ask you, is it good or bad? Now, there is two results will come from here. The first one will be, okay, my plan was to use 1 hour. My plan was to use 1 hour, and let's say for the employee, for 1 hour we paid £10, but actually we have used 1.5 hour, and that makes me cost £15, and £5 I spent more than my planned. So my plan was I'm going to spend £10 for 1 hour, but actually I have spent it 1.5 hour. So I have spent zero point 0.5 hour more, and that makes £5 extra cost for me. So from that point of view, this £5 will be adverse because I have to pay some more money. The company have to bear some more cost. Now the question is, the plan was in 1 hour to make 10 unit, but actually in 1.5 hour the employee make 20 unit. So that is more than the expected. Now, if you tell this employee, listen, you're supposed to spend 1 hour, but you have spent it 1.5 hour. So this is bad for the company, and because of that company have a adverse variance £5. Now this employee will reply to you and he will tell you, listen, even though I have spent it half an hour extra, but I have made 20 unit, not 10. So I supposed to make only 10 unit in 1 hour, but actually I have made 20 unit. So from the employee point of view, he done very well because in 1 hour the plan was 10 pen, but he made actually 20 in 1.5. So he saved half hour. So when you consider that, this is called flex budget. When you consider that, this is called flex budget. So how does it work? I said, okay, so in 1 hour you're supposed to make 10 unit, so now you make 20 unit. So let me tell you how many hours you should need to make 20 unit. So I said, okay, so 1 hour 10, so 20 unit should take 2 hours. 20 units should take 2 hours, but actually you take 1.5 hours. So we have saved zero point 0.5 hours, and the per hour is £10. So actually the variance is favorable, not adverse. So you see, is basically upside down. So when you consider the first scenario, I just compare the budgeted with the actual. When I compare budgeted with the actual, I see the variance is adverse for the company. But as soon as I make it flex, as soon as I change it with the actual outcome, I can see it is not adverse, but it is favorable. So now we understand actually based on the activity level we have to change it. So there is two way to calculate the variance. The first one is original budget minus actual. That will give you the variance, what was my plan and what was the actual outcome. And the next one is flex minus actual. So based on the actual output of the unit, I will change every single category of the income and expenses. So for example, if I had a plan to make 10,000 unit of this pen, and if I made 15,000, so all my cost, all my income will be changed based on 15,000, not 10,000 anymore. And after that, I'll compare this activity that I have calculated for the flex with the actual. And this difference will be the variance analysis by considering the flex budget. So there is two way, one with the original budget and the actual, and the next one is flex minus actual. So of course we know we have some costs. So the company have direct material, direct labor, and the overhead. These three, these three are the cost for the company, and the sales is the income. So if cost, if cost is more than budget, if cost is more than budget, this is bad for the company. So that will bring you adverse variance. So let's say my plan was direct material cost will be 10, and actually direct material cost is 12. So 2 will be adverse. So if the cost is more than the plan, that will be the adverse variance. But on the other hand, if the sale is more than the plan, for example, if my plan was I'm going to make £100 sale, but if the actual sale is 120, so that means the difference 20 is favorable because it's a sale. If sale or operating profit or anything, if this one more than the budgeted, that is good for me because sale is good for me. So if sale is more than the plan, is a favorable. But if the cost is more than the plan, this is bad. So if the cost is more than expectation, this is adverse. If the sales or income is more than expected, it is favorable. All right. So this is the basic understanding of the variance analysis. Now we're going to do some practice and try to understand more from there. So let's move on and see one of the activity. There are some template here, but we're not going to discuss that because we understand already the variance analysis means the difference between the budgeted and the actual. So let's do one of the example from here. So we can do this question really quick because we don't have to write everything. This question is really easy. This question is asked us, we have a flex budget, and the question is asking to find the variance and tell is it adverse and favorable. Now remember that if the flex budget and the actual budget unit is same, for example, my plan was I'll make 10,000 unit, and actually I make 10,000 unit. So there is no difference. If my plan was I will make 10,000 unit, and actually if I made 10,000 unit, that means there is no difference between the budget and the actual. That means there is no variance. There is no movement of the cost and sales. So what does that mean? That means if I make a plan, I will make 10,000 unit, and if I actually make 10,000 unit, I don't have to change the cost. I don't have to change the selling price because what was my plan, actually I made that. So because of that, I don't have to change anything. So you don't have to make the flex. Flex means you make it flexible. Flex means you change the budgeted cost based on the actual output. So we can see here our plan was we're going to make 100,000 unit. So you're going to sell 100,000 unit. That was the plan, that was the budget. But when we look at the actual result, we see actually we sold 100,000. So there is no difference. So if my plan was 100,000 and if I actually sold 100,000, there is no difference. So that means I don't have to change my budgeted cost. I don't have to change it because my plan, my budget 100% correct with the actual result. So I don't have to change anything. I just need to compare. So what was the plan and what has actually happened? And we need to say, is it favorable or is it adverse? So I really don't have to do it here because it's really easy question. We can do it here on the question. So let's try to do it together. So there is no difference There is no difference with the volume. So we can say there will be no difference with the sales volume. So this is basically equal. There is no difference. That is actually 0. So make your calculator ready and let's do this question together. So first we do with the sales revenue. If the sales revenue is more than the plan, that will be good for us, and good means favorable for the business. So let's say sales revenue, my plan was 3000, but actually I sold it for 5400. So how much is the difference here? 5400 is the actual and the budgeted is 3000. So the difference here is 2400. 2400. So the first thing is I have to say is the difference. So how much is the difference? So 2400, and I need to say, is it good or bad? If it is good, it is favorable. If it is bad, it is adverse. So my sales is more than my expectation. Is it good or bad? So is it favorable or is it adverse? You have to tell. So my sales is more than my plan. So I would say this is favorable. So I'm going to write F A V, favorable, because it's a sales. And if sales is more than my plan, this is good for me. If it is good, it's favorable. If it is not good for me, that will be the adverse. I will request all of you, if you can join on time, that will be really great, because we have like 60 students in this class. So every 5 minutes, if you keep joining, I have to go and I have to make sure like I make you accept in the class. So I have to go every time. It's better if you can join on time. And sometimes if you miss even little bit, you miss maybe the whole part, because at the beginning I try to explain what you're going to do, how we're going to do. So maybe when you move to the question, if you miss even 5 minutes, the 5 minute could be important for you. All right, let's talk about the next one. The next one we have the direct material. So now the material is a cost for me. It's not, if it is more than my plan, it is not good. So my plan was 525, but actually it is 795. Now how much is the difference? 270, 270. And is it adverse or is it a favorable? This is our adverse, because this time it is not a sell, it is our cost. So if the cost is more than my expectation, that cannot be good for me. So this is adverse. So I would say ADV, adverse. Then we have a direct labor. We'll do the same way, the way we just done for the direct material. We need to find the difference. So the difference is 120 and it is adverse. Then we have a overheads. It's also cost for the business. So you need to find the difference. So my plan was 1470, but actually it is 1842. So 372 adverse. Finally, the operating profit. My plan was I'll make a profit 405, but actually I make a profit 2043. So I make a lot of profit, more than the expectation. So you need to find the difference. How much is the difference? 1638. And this is our favorable. Very well done. Very well done, Jerno. Very well done, Michelle. Very well done, Luis. I'm sure all of you understand this is a very basic understanding and shouldn't be an issue with this question. But if you still feel, if you have something to ask, you can ask me now, or we can move to the next question. So let's move on to our next question. The next question we have this time, ZTAC Limited, and you can see this time the budgeted and the actual is not same. So this time we can see the budgeted unit is 10,000, but actually I made 12,350. So I made more than, or I sold more than the plan. So all this cost, sales revenue, cost, everything that I have decided before, that was based on the plan of 10,000 unit. That was the plan. I will make 10,000 and I will sell 10,000. But actually, the result is I have made 12,350. So now every single cost, every single income, all of this I have to change based on the actual output, that is 12,350. So I'll change everything based on this figure, and after that I'll compare with this actual. So I'll change the budget and I'll make it flex budget. And after that I'll compare with the actual. All right, so we'll do it maybe on the box, but before that I want to write it down information here, because if I go down I will not see this. So let's write it down a bit quickly. Folium sold, that is, you can do some calculation by yourself by the time I'm writing. 12,350. Then we have sales revenue, that is 300,000, the plan, and the actual is 407,550. Then we have a cost, direct material, 50,000 was the plan, actually it is 53,000. Then we have a direct labor, 40,000 was the plan, and actually it is 49,000. Then we have overhead, the plan was 110,000 and actually it is 178. And the operating profit, 100,000 was the plan, actually 127,550. All right, so all the information we just copied, so that when you go to the actual result, actual writing box, we can see everything. So now, as we can see, the plan was 10,000 and actually it is 12. So I have to change everything, isn't it? So we have to change based on this actual amount, 12,350, everything, the cost, the income, everything. So let's find the first thing. So write it down, the flex budget. Now there is no normal budget, there is no budget, there is no fixed budget, only the flex. Flex means I will change every single cost based on the actual outcome. So flex budget will be based on 12,350 unit, and my actual is 12,350. So all the costs I have, I'll change based on that. So let's have a look. The first one, sales revenue. The sales revenue 300,000 was planned for 10,000 unit, isn't it? So how much the sales revenue I'm expecting based on 12,350 unit? So I can do it very easily. I can say 300,000 was the plan for 10,000 unit, and if I divide that, that will give me per unit, and if I multiply with that with 12,350, that will give me the total revenue for 12,350. So all I have to do, I have to find how much is the sales revenue per unit. How can we do that? The total revenue divide total budgeted unit times by the actual output. So that gives me how much? 370, 500. 370, 500. That's my flex. And I can see the actual is 407. So 407, 50. That's my actual. So based on my plan, 12,350 unit should make 375 sales revenue, but actually more is
That's the kind
400,000.
of issue.
So how much is the difference here?
That's, that's really frustrating.
407,550 minus 370,500. That will give me the difference, like did I make better or did I make worse. So if I do good, is favorable. If I do bad, it is adverse. So my plan was, based on my plan, my sales supposed to be 370,500, but actually the sales is 407,550. So the difference will be 37,050, and this is basically more than the plan. If my sales is more, remember it is good for me, it's not the cost. Cost and the sales is opposite. If the sales is more, it is good for me, and if it is cost, if it is less, then good for me. So cost less is good, sales more is good. So I said, is it favorable or is it adverse? Is it good for me? So of course I can say it is favorable. Then the next one, we have a direct material. Let's talk about the direct material. So based on my plan for 10,000 unit, my direct material was 50. So let's find the direct material cost per unit. So I said 50,000 divide 10,000 times 12,350. So if I divide with that 10,000, that will give me the direct material per unit. And if I multiply the actual output, that is 12,350, that will give me the direct material cost for 12,350 unit. So how much it will be? 50,000 divide 10,000 times 12,350. So that will give you 61,750. So that's my flexed 61,750. So 61,750, and my actual direct material is 53,000. So I'm going to write 53,000, and I have to find the difference between the budget and the actual. So that difference will tell me, is it favorable or adverse. It's the cost. So the cost is less than my plan. So my plan was the cost will be 61, but actually my cost is 53. So that is less. So I would say the difference is 8750, 8750, and that's good for me because cost is less is good. So that's favorable. Very well done, Alicia. Very good, Zumpa. Very good, Ahmed. Yes, this is right. Let's move to the next one. Direct labor. Can you do the same way, the labor? So direct material labor cost is 40,000. So 40,000 divide 10,000 times 12,350, and that will give me 49,400. Very well done, Kurt. Very well done, Julia. So 49,400, and the actual is 49,000. So actual is less, isn't it? So the difference is 400, and this is good for me, favorable. Very good, Michelle. Very well done. Then the next one, we have the overhead, 110,000. Same way, can you do that as well? So 110 over the way we did before. So we'll do that. So this is how much you have. Overheads, so 135, but we need to see, is there anything they said for the overhead? So fixed overhead, do not change volume, activity change, but actual fixed overhead change 110. So that was the plan, 110. So based on that, how much will be it is? So let's do that, 110 110. So 110,000 divide 10 over 12 350. So that is 135. Okay. So 135, 800. And is it fixed? Is that question said to us? Let's read that. If it is fixed cost, it will not be changed. Remember that. So complete the table below to show flex budget and resulting the variance. Show the actual variance, adverse. Okay. Let's have a look in the top. Okay. Both the direct material and the direct labor are variable cost, but the overhead are fixed. Okay. Oh, very well done. So we have to read the question. You see that? So if we missed a one line, maybe we can have a different result. So we need to make sure we read the question. So they said the overhead is fixed. And remember that if something is fixed, it will be never changed with activity level. If the question already mentioned any cost that is fixed, we don't change it. Even it is a flex budget. Remember that. Even if it is a flex budget, still we're not going to change it because it's fixed. For example, if we have a rent, £10,000, doesn't matter if we make any unit or not, the rent will be fixed anyway. Let's say if I close my building, still I have to pay the rent. So fixed costs never change with the activity level. If the question mentioned clearly these costs are fixed, normally the fixed production overhead it is fixed. But if it is say overhead only, overhead can be variable, can be fixed. So you have to look for more information. If the question said overhead are variable, then the way we did so far, you do the same way. If the question said no, overhead are fixed, then we don't change it. All right, very well done. So let's try that. So we have 110. That was the plan. And actually it is 178. So the difference is 68,000. That is more than my plan. So that will be our adverse. Very well done. And finally, we have operating profit. How do we calculate the operating profit? So we have a cell. So we add all this cost. 1, 2, 3. These three costs we add. After that, we minus it from the sales revenue. So we added 61,750 plus 49,400 plus 110, and we minus it from 37500, and that will give us the operating profit. So that will be how much? 149,350. Very well done. Can we do the same way for the actual one? So we have the cost and minus the sales. So 127,550. Very good, Tidora. And we have the variance analysis. Now the variance analysis, we can add all this favorable. So this is favorable, this is favorable, this is favorable, and that's the only one we have adverse. We will minus that, and that will give us the total difference, 21,800 adverse. If you do from here, it will give you the same result anyway. So that's how we can complete our variance analysis. And you need to make sure, like, if this question come in the exam, you don't lose any marks because this question is quite simple. All you have to identify is it favorable or if it is adverse. Sometimes the question also asks some question like on the implication of the profit, but if we have any question, we'll see that from here. All right, so let's have a look and find it out more. Now, this type of question, investigating the variances, could come as MCQ format. They will not ask you to write something why there is a adverse or why there is a favorable. They will not ask you this question. They will ask this question to analyze the variance analysis when you will be in level 4. So when you will do your level 4 management accounting, budgeting, and the decision making control paper, then you have to tell what's the reason behind the variance analysis. But for the level 3, you don't have to. You don't have to write a statement for that. Normally, Osim, this question will be mixed with another question, so there will be no fixed question for the variance analysis. So you will have one question, and maybe the requirement number B, or there will be 5 marks question will be added for calculating the variance. So the investigation means what is the reason behind this variance. For example, if you see the material variance is favorable, what could be the possible reason? Maybe you received a discount from the supplier. That could be a reason. Maybe you buy a lot. Maybe you did more analysis. You look at so many supplier and you have buy the best one with the best price. Maybe the material is not wasted, so you use it more efficiently. Or maybe there is an error allocating the material job. So this is the possible reason your material variance could be favorable. On the other hand, what could be the possible reason that your material variance could be adverse? The first reason is price increase. Maybe the material you have buy last time, and this time when you're going to buy it, maybe the price is more, so that could be one of the reason. Then careless purchasing, so you just buy randomly, you don't check from every single supplier you have on the market, you just buy it really quick and you paid more money for that. Then defective material, if you don't buy very good quality material, maybe the machine need more material and there will be wastage. So because of that, maybe you need more material that will lead to the adverse variance for your material. Then wastage or theft. Then stricter quality control. So if the quality control is really high, for example, if there is a little bit damage of the raw material, you just throw it, you don't use it. So if the quality control is really strict, maybe your material cost will be higher, and that could lead to the adverse variance for the material. Then could be mistakes or error. So this is the possible reason for the favorable and the adverse for the material variance. We have the same thing for the labor. So let's have a look for the labor. Maybe the labor you are using maybe not very good, so use the worker lower rate. So if you use the worker and pay very low, maybe they're unskilled, so that's why you have a favorable labor variance. Then maybe the labor are very efficient, so they make the unit very quickly. Or maybe there are enough training provided to the employees and they become more efficient and they utilize the time perfectly, and they basically making the unit more than the expectation. So that could lead to the labor variance favorable. On the other hand, wages rate could increase, that could lead to adverse variance. Then output lower than standard, so obviously that could be lack of training. And the idle time, and the idle time means basically you paid to the employee but for some reason uh, they didn't work that time. So let's say there is a breakdown of the machinery, there is a power cut, there is a virus on the computer, so for some reason employee couldn't do the work but still they get paid for that. This is called idle time. Then we have a fixed overhead, so you can read that sales revenue why it could go up and down. So obviously this is not very difficult to understand. Absence of labor is depends, Osim. If the employee is absent and if you still need to pay it for that, then that will make adverse variance. But if the employee don't come, and if the employee have no effect, because if he don't come, then obviously maybe there is no impact on that. It depends on the situation. All right, so we have some. I think that's all we have. There is some explanation of the responsibility. I think you can read yourself, and there is a definition what is favorable. I would say it's very simple. If it is good for the company, is favorable. If it is bad for the company, is adverse. So if you remember that, that will be enough for you to make your answer very correct. All right, any question from here? This is the end of the chapter. We can move to the next chapter. If you have any question, you can ask me now, or we can move to the next chapter, chapter number 12. All right, very well done. Now the next chapter we have, it is called cost bookkeeping. Now normally, hardly any question tested in the exam from this chapter. It's not very common. The process costing or WIP, work in progress, always will be seen in the exam. But from this chapter, I would say like not many question you will see in the exam. If any question come in the exam, it will be less than 5 marks. But still, you need to know. And I'm sure all of us we know our debit and credit. So this chapter is all about debit and credit. But this is only for the material, labor, and the production overhead, not for anything else. Now, let's have a look, try to understand a little bit our cost bookkeeping for this material, labor, and production overhead, and how we basically record in every single steps. Now, let's try to understand basically from our raw material till the finished good. Let's have a look how does it work. So what we do, if I try to show you something here, maybe that will be more helpful. Let's say this is our raw material. So raw material. So raw material. Let's say this is our raw material. Could be anything. Depends on the organization requirement. And this raw material, what we do? The first thing we buy this raw material, purchase. So first thing we do, we purchase the raw material. Purchase raw material. Now, when you purchase the raw material, what happened? The raw material come to me because I buy the raw material and I have to pay for that either immediately or I pay later on. So when I purchase the raw material, I said the raw material will be debit because it's expense for me. So I said debit material, and the credit, it could be cash or could be payable. Credit cash, if I paid immediately for the material, then it will be cash. If I said to my supplier, I will pay you later, or if it is a credit purchase, then that will be payable. So payable will be the credit, credit payable. I'm sure all of you know the difference between the cash purchase and the credit purchase. So cash purchase means when you have to pay immediately, and the credit purchase means when you pay later, not immediately. So if there is a cash purchase, we called it cash credit because money will go immediately. Even if you paid from the bank, it is the same story. Or if you pay later on, then it will be payables credit. Now, the next step, what we do with this material. So as soon as we have the material with our hand, what we do, we use it, isn't it? So this material, later on, I put in the machine. Let's say this is the machine, and we use this material inside of the machine, isn't it? So let's say we put all this material inside of the machine, and from this machine we have finished good. Finished good. So as soon as, let's say this is process number one, step number one, step number two. As soon as we move to the next step, so where we put all this raw material, So this box will be empty, isn't it? So this raw material pallet, this raw material container will be empty because we put all this raw material inside of the machine. And as soon as something I put in the machine, and if the machine start working, processing, until the finished good come out, we call it WIP. We called it WIP. WIP. So if something on the machine, the product is not completed yet, is still processing, we called it WIP, work in process. So as soon as we put everything on the machine, there will be a journal for that. So now the journal will be WIP debit, WIP debit, because this material is now with the WIP, that will be debit. And if you remember, the material was debit before. Now the material is no more in the container, so I have to say material is credit, because the material is not no more there. So I took all the material, so put everything on this machine, so the material is finished. I have to finish it. So if I want to remove it, I do the opposite entry. So before that I said material is debit. Now I will make material credit, so that debit and credit will be opposite each other. We remember that debit and credit is like a plus and minus. If I need to remove something, I do the opposite entry. If something is debit, if I want to remove it, I make it credit. If something is credit, if I want to remove it, I make it debit. So I said the material is now inside of the machine, so the container is empty. So let's make the material credit. So material credit. So that means this is gone. Now from here, my next step will be, from the machine, the complete product will come out, the finished good. If something is completely done, ready to sell, we called it finished good. So now we have to see how we work for the finished good. So if we have the finished good, now the raw material will be finished. So all of this raw material will be finished as a finished good. So I said finished good will come out. Let's say this is one of the unit. Let's say is a bread. One bread we make, that's the finished good. Finished good. And what will be the journal for that? We said debit, finished good. And this container is now empty. The machine is now empty, so I have to make it empty. So before I said WIP debit, now I will make WIP credit, so it will be vanished. So I would say credit WIP. That's it. Now, from the finished good, what we do? This finished good is called it inventories. This finished good we called it is stock, and stock or inventory is a part of cost of sales. Inventory or stock is a part of cost of sales, because all the inventory stock we make, at the end we include everything on the cost of sales. So we said later on it will move to the cost of sales, COS, cost of sales or cost of goods sold, the same thing, COGS. COGS. Cost of goods sold or cost of sales is the same thing. So once we recorded everything from the finished good, so the new journal will be cost of sales debit, debit cost of sales, and the credit will be finished good, because this will be now gone, and the new name will be cost of sales. So finished goods will be finished, and it will be cost of sales. So before finished good was debit, now I make finished good credit. Now finally, once everything go to the cost of sales, finally I take it to the profit and loss account, because the cost of sales go to the profit and loss account. If you remember that, sales minus cost of sales, and inside of the cost of sales we have a opening inventory, we have a purchase, we have a minus closing inventory, and that gives us the cost of sales. So ultimately this will go to the profit and loss account. So we said, and it will come to the debit side because cost of sales is expense. So we said it will go to statement on profit and loss account. And the journal will be debit, SOPL, statement of profit and loss, and the credit will be cost of sales. So this is basically little explanation to make you a little bit understand exactly. We start from the raw material and we basically come down to the SOPL, profit and loss account, and few steps is involved there. Now, when we do the journal, if you remember all the journal we have done before, we said cash purchase, credit purchase, deposit to the bank, capital, all of this. We know all of this, but only for the material, only for the inventory, there are few steps. So now, if someone asks you, okay, you are in the cost of sales, can you go back? So you can go back up to the raw material. And if someone tell you this is the raw material, can you come down up to the profit and loss account, the last step? You can say yes, this is a step involved with that. So that will start making more sense to you. All right, so we have the same thing explanation here. So you can look yourself later on. So it's the same thing we have here. Then you have a labor, same thing. So on the WIP means the work is still going on, it's not done yet. And you have the production overhead. Now, the production overhead, a little bit issue we have, if you remember, our over absorption and under absorption. This one you have to be a little bit careful. In the exam, student also get confused about that, the over absorption and the under absorption. So I want all of you to spend some time on these two, over and under. Now, over absorption means when I absorbed more. For example, the absorption for the overhead supposed to be 100, but I absorb 200. So I shows or I represent more expense. And because of that, my profit shows less. So if there is a over absorbed, my profit has to be go up because that's not my actual overhead. I absorb more. If this is under absorbed, obviously that have to be reduce the cost. So under absorb means I absorb less, so I have to increase the cost. That will reduce my profit. So you have to remember that, try to understand with some example, and when you do actual example, that will start making more sense. But over and under absorption we have done previously as well. I hope you remember all of that. So you can see the production overhead is expense, so that will be debit. Now, if we paid cash, the cash will be credit. If we don't pay cash, if we pay on credit, that will be our payables. And some of them will be transferred to WIP. So the work is still not done, it is on process. Then if it is completed, then it will move to the statement of profit and loss account, the overhead. Now, when you move all of this overhead to the profit and loss account, we have to consider under and over absorption. So we can see, so record additional expense. So if there is under absorption, I have to increase the expenses because I absorb less. So that will go to the debit side on the profit and loss account, and the credit will be production overhead. Now, normally the production overhead is debit. If something is debit, if I want to reduce it, I make it credit. I said so many times debit and credit like a plus and minus. So if the production overhead is already debit, if I want to reduce it, I make it credit. If I want to increase it more, I make it debit. And if I do the over absorption, obviously I have to reduce the cost. So in that case, I have to say production overhead will be debit. I want to increase the cost. I said this is like I over absorbed. So obviously I need to increase it. So if I do that, that will do overhead absorption will be the debit. I want to increase it. This is normally debit. If I want to increase it, I'll make it more debit. If I want to decrease it, I'll make it credit. So under and over absorb, you need to ask yourself, did I absorb more? If the answer is yes, then obviously you have to reduce the cost because you absorb more, you shows more cost. And if the question is, did you absorb less? If the answer is yes, that means you have to make some additional expense, and that will basically reduce the profit. All right, so let's move on inside of the chapter and let's have a look what we have here. So this is the chapter overview. There are few explanation here, so you can read yourself. The control account. So we have few control account. Now, control account is a general ledger account, of course, like the double entry. I'm sure all of you remember that, but still you will do whatever we have here. Now, the basic double entry, debit and credit, and I want all of you to read this chapter by yourself, just to refresh your memory. If you forget your double entry, the debit and credit from level 2 or from the advanced bookkeeping paper. So let's start with activity 1, because more you practice will be more efficient for, and will be more ready for the exam. So only the practice thing will make us more effective. So let's have a look. Activity 1, control account. We have B and Co. So B and Co spent the following in 2002. Raw material brought on credit. So they buy on credit. Okay. So if you buy your raw material on credit, can anyone tell me the journal? What will be the journal? So purchase raw material on credit. What will be the journal for that? So journal, journal. So materials, so the raw material will be debit, raw material, or the material, whatever you said. Material will be debit, 5,000. And because I didn't pay it immediately, I'll pay later. So the payable account will be credit. So payable will be credit, 5,000. So the material is debit, payable is credit. We understand this one, very simple. And from the journal, we have to move it to the ledger account, isn't it? We know how to do it. So we have a material and we have a payable. So we said payable, and we have a material, material. From the journal, we already know we have to prepare every single ledger account based on every single entity we have. So you have a payable and you have a material. So let's do the payable first. Credit. Payable is credit, so my pen will be on the credit side. Payable is a credit and it's a payable account, so my pen will be credit side, but I'm going to write the opposite. I'm going to write the material. So I'm going to write material, that is 5,000. And the next one I'll do material. Now the material is a debit, so my pen will be on the debit side. We already know the left hand side is the debit side, the right hand side is the credit side. So this side is the debit side and this side is the credit side. Debit and credit. Even if we don't write, we have to remember left hand side is always debit side and the right hand side is always credit side. So material is debit, my pen will be on the debit side, but I'm going to write the opposite. I'm going to write payable, 5,000. So that's how we do our ledger account from the journal. I hope you remember that. If not, you can revise your level 2, some of the bookkeeping paper or advanced bookkeeping. That will help you to understand more, to remember your debit and credit. So this is the payable control account. So on this side, I'm going to write material. So material, 5,000. And on the raw material account, I'm going to write payable, 5,000. That's it. So that's just a simple debit and credit. So if you have any question, you can ask me, or we'll move on to the next one. Move to the next one. On activity 2, let's read that. We said we are following the last activity, activity 1, because we can see now we make a payment to the supplier. The activity 1, we have purchased, but we didn't make the payment. We purchased on credit. Now in activity 2, we are going to make the payment to the supplier. So in activity 2, payment to supplier, B and Co. So it says B and Co makes the following payment in 2002. Payment to supplier for raw material brought on credit, 5,000. So what will be the journal for that? Can anyone tell me what is the journal for that? Activity 2. So we said yes, payable will be debit. Very well done. So payable is debit because payable before was credit. Now I want to remove the payable because he's not my liability anymore. If I make the payment, so I will say you are not my liability anymore, so I have to remove you. So before my payable was credit, now I'll make it debit, and debit and credit like a plus and minus, so he will be gone. And how do I pay it? I paid from my bank, so obviously my bank will go down. If I paid from my bank will be, my bank balance will go down. So if the asset goes down, it's a credit. Dead and click. Still you remember that? So dead and click. So payable is debit, bank is credit. Very well done, Zumpa. Very well done. Very well done, Yuan. Very well done, Tidora. Yeah, so let's start that. So payable control account. Now payable is a debit. So on the debit side, I'm going to write bank. Bank, that is 5,000. And bank is a credit. So on the credit side, I'm going to write payable. And that is 5,000 as well. That's it. All right, let's move on to the next activity, the activity 3. Now, the next activity we have, this is says issuing materials. So B and Co. B and Co issue all the material to production for use in the work in progress. Now, from the raw material, we move everything to the work in progress. So I'm making empty the material and put everything on the machine of the work in progress. So what will be the journal for that? Can anyone tell me the journal for that? So the work in progress will be debit. Very well done. Yes, because all this thing will be on the work in progress, debit, and the material will be credit. Very well done. Material will be credit because the material will be no more. So the material was before debit. I have to finish it. I make it credit, and the new account will be created. That will be the WIP. So I said here we have a raw material account. So when we have a WIP account, so this is my debit. So on the material is a credit. So on the credit side, I'm going to write WIP. That is 5,000. And the WIP account, this is debit. So on the debit side, I'm going to write deposit. That is materials. That is 5,000. So that's how we can do all these journals, and you can see it's not very difficult. And hopefully if this question come, as I said, is hardly tested in the exam, but if this thing come, you can make these journals and the ledgers. Then the production overhead, the next step, the production overhead is debit, then cash credit, production work in progress is debit, production overhead credit. This journal we already explained before. So let's have a look on the activity 4. There is some explanation. Make sure you can read this. So that will be helpful for you to understand more for the over and under absorb. All right. So let's have a look this question activity 4. In this activity 4, we can see here we have a recording production overhead. So if there's a recording, so the production overhead will be debit, and if we pay immediately, then it will be cash credit or it will be payables. And after that, we move it to the WIP. So production overhead to be absorbed in WIP. So from 6,000 production overhead, we can see 4,000 we have absorbed to the manufacturing department, then finishing department 600, and the quality control 500. So this 3 is on the WIP. It's not completed. So anything is the difference between 6,000 and this 3 is basically will go to SOPL, the statement of profit and loss account. And anything, remember, on the WIP that we don't take to the cost of sales. Cost of sales always is the completed. Cost of sales is something is completed. It's not something WIP. WIP cannot be the part of cost of sales. All right, so let's try that. So we have a payable account. So on the payable control account, we're going to write production overhead, because production overhead debit, production overhead debit 6,000, and payable credit 6,000. So payable is a credit. So on the credit side, I'm going to write production overhead. Overhead 6,000. All right, so move to the next one. So the next one, I have to do the production. The next one I have to do the production overhead control. Okay, so let's move on to the next one, and let me erase it first. All right, so yeah. So we have the production overhead control account now. So we have to record all of this here. So on the production control account, it was debit. So on the debit side, I'm going to write payable. So payable 6,000. And the next one we put everything on the WIP. So WIP account will be debit, and production overhead will be credit. So we have 3 WIP. So let me keep some space. So let's keep some space. WIP is a debit, and production overhead is a credit. So let's have a look how many WIP we have. So we have manufacturing department, we have finishing department, we have a quality control. So we have a 3, 4,600 and 500. So let's write it down all 3. So let's write it down for the WIP. I'm writing M for manufacturing 4,000, and F for finishing, that is 600, and Q for quality control 500. All right, so we're going to write this side overhead absorbed. So overhead absorbed, manufacturing department 4,000, for the finishing department 600, for the quality control 500. And as I said, any difference between the payable and the WIP, that will be go to your profit and loss account. So if you see any difference, that will go to the statement of profit and loss account. And 6,000 minus 4,000 minus 600 minus 500. So that will give you 900. This will go to the profit and loss account. Finally, we have a WIP account, and inside of the WIP we have a 3 thing: 4,000, 600, and 500. If I added all of this, so 5 and 6, 11 plus 4, 5,100. So 5,100 will come. WIP is a debit. So on the debit side, I'm going to write production overhead. That is 5,100. All right, so this question obviously, like as you can see, it is not very difficult. It's just a debit and credit. And as I said, this question will be not very like tested in the exam. So you can still practice, of course. If it is even come, it will be linked to the another question. So I would say like there are one more activity from this chapter. So there is a summary of the double entries you can read. So activity 5, I will leave for all of you as a homework. So you can try that. If you're stuck in any question, we can discuss later on. But I will keep one activity, that is activity 5, for your homework. So let's move on. And there is some illustration as well, like profit and loss account, raw material. This thing even not relevant to this paper because this thing will be relevant to your final account preparation, prepare this thing. But here you just need to learn the journal. Remember that if all the journal, for example, payable to HMRC, the pension scheme, the plant and equipment, this thing you already done, like from the journal, how to prepare the ledger account. So if you have a journal, all this list of journal, after that you make the ledger account and the balance CDBD go to the trial balance later on. So this is nothing something new for us, but still you can quickly revise yourself, just refresh your memory. And after that, maybe if you have any question, you can email me. We can discuss after that. All right, so let's move on to the next chapter. The next chapter we have, that is marginal costing. Now, the marginal costing is the method of costing. Marginal costing is the method of costing. There are few methods that we have follow when we calculate the unit cost. Unit means like any product. Unit can be anything. So if I have a business for making the pen, so my pen is the unit for me. If I make the paper, so paper is the unit for me. So unit basically is a business term. So we call the unit every single product we make, we call it unit. Now, when we try to identify the cost for a unit, we called it unit cost. So unit cost. Now, to calculate the unit cost, we have to follow some method. There are three methods that is widely common and very popular. The first one is called AB costing. It's called absorption costing. AB costing is the absorption costing. Sometimes we called it full costing method. So in the exam, if you see the absorption costing, or if you see the word full costing, is the same thing. So absorption costing is also called full costing. The reason it is called full costing, because the fixed cost is also part of that. In absorption costing, we also include the fixed cost. This is the reason we called it full cost. The next one we have MC, that is called marginal costing. In marginal costing, we only consider the variable cost. Only variable cost. So in marginal costing, we only consider the variable cost, not the fixed cost. And finally, we have another one, that is ABC, activity based costing, where we look at all the cost driver and everything. So we have done this one before. This is not part of this chapter, but this is the three costing method we have when you try to identify a cost for a single unit. This is the method we're going to follow. Now, this chapter is called marginal costing, and most likely we're going to see everything from this chapter for the second one, the marginal costing. So let's go inside and have a look what we have here. So on the chapter overview, we can see here we have marginal costing. So yeah, that's nothing else. So that's only this small chapter overview. Now on the marginal costing, we can see we have a fixed cost and a variable cost. Fixed cost and the variable cost. I'm sure I don't have to tell the definition to all of you, the difference between the fixed cost and the variable cost. The fixed cost is the cost that never change with the activity level. So even though the unit go up and down, the fixed cost remain fixed. So regardless of the activity or regardless of the output, the fixed cost remains same. On the other hand, the variable cost is quite flexible. So if I make more unit, the cost will be more. If I make less unit, the cost will be less. So variable cost is changed with the activity level. Now, in marginal costing, the fixed cost will charge as a period cost. There is two type of cost that we categorize for the fixed cost. So let's say fixed cost, and this fixed cost we have a two category. The first one for the absorption costing, The next one for the marginal costing. So for the absorption costing, fixed cost we charge as a product cost. Product cost. So for the fixed cost, we charge as a product cost. So if there is a fixed cost and if it is absorption costing, so the fixed cost will be charged as a product cost. On the other hand, if it is a marginal costing, the fixed cost will be charged as a period cost. Period cost. So one is product cost, one is period cost. Now let's discuss a little bit what is the product cost and the period cost. Now, product cost means the fixed cost inside of the product. The fixed cost is the part of the product. But if it is a period cost, that means the fixed cost is not inside of the product. For example, let's say we have a pen. So let's say this is a pen. And in this pen, the cost is £10 total. This is the cost for £10. Now, if I ask you, inside of this pen, is there any fixed cost involved? If I ask you, inside of this pen, is there any fixed cost involved? The answer will be what type of costing method you used. So before I answer, no, there is no fixed cost inside, or there is a fixed cost inside. Before I say this thing, I have to ask you what type of costing method you followed. Now, if the reply is I use the absorption costing, then I said yes. If we use the absorption costing, that means the fixed cost is inside. If we use the absorption costing, that means the fixed cost is inside of the product. Now, if I said no, I have used the marginal costing, that means the fixed cost is not inside. So here, all this £10 is the combination of marginal cost, only the variable cost. There is no fixed cost inside. So the simple thing is, if it is a absorption costing, fixed cost inside of the pen. If there is a marginal costing, there is no fixed cost inside of the pen. So fixed cost only come inside of the unit cost if we use the absorption costing method. If we use the marginal costing method, there is no fixed cost inside, only the variable cost we consider inside of the product. And in marginal costing, the profit we call contribution. So sales minus variable cost, we called it contribution. Sales minus all the variable cost. Sales minus all the variable cost, we called it contribution. But in the absorption costing method, we said all this cost, so sell minus all cost, the difference we have, we called it profit. So we don't have to calculate the contribution. In absorption costing method, we do not calculate the contribution. The contribution is only calculated on the marginal costing method. So if I use the marginal costing method, so sales minus all the variable cost, that will give me contribution. And if it is a marginal costing, then sales minus variable cost is a contribution. So for example, let's say we have a one unit. Let's say we have a unit A and unit B. So we have a direct material, £10, £10. Let's say here I'm using absorption method. Here I'm using marginal costing method. So for the product A, I'm using absorption costing. For the product B, I'm using marginal costing. So direct material, same for both. Only the issue will come for the fixed cost. Remember that. Only the issue will come for the fixed cost. So direct material 10 and 10, direct labor 5, 5. Then you have a variable production overhead 2 and 2. There is no problem for that. Now when the fixed cost will come, fixed cost per unit, fixed cost per unit. In absorption costing, the fixed cost will come here, let's say £1, but here will not take it. So in the marginal costing, we'll never take any fixed cost part of the unit cost. So let's say the absorption costing is says 10 plus 5 is 15 plus 3 is 18. The marginal costing will be 17. So the unit cost, if I use the absorption costing, that will be definitely more. But if I use the marginal costing, that will be less, because there is no fixed cost inside of the marginal costing. So if someone asks you, if I using the absorption costing, my unit cost will be more or less, the answer will be more, because you understand why. If the question asks you, okay, you said the absorption costing will give you more unit cost, why? You said because there is a fixed cost inside. If someone asks you the same question for the marginal cost, you said the marginal cost, the unit cost will be lower than the absorption cost. If the person asks you why, you said there is no fixed cost inside, that's why. So that could be like all of this thing that you have to consider for that. So let's do some practice so you try to do more, understand more from here. So let's start with that, and maybe after that we'll take a break. So let's quickly finish that activity 1, then we'll go for a break. So the activity 1, we have the contribution. So contribution means sales minus all the variable cost. Sales minus all the variable cost. So sales minus all variable cost is called contribution. So we have a sales for JKL. So sales is 10 for J. And we have a variable cost 1. Labor is a variable cost. Variable sales cost is a variable cost. Variable overhead is a variable overhead. But we do not take the fixed. Remember that. Fixed cost we never consider to calculate the contribution, because contribution means sales minus all the variable cost. So 10 minus 3 minus 1 minus 25 pence minus 75 pence. That will give you the contribution. So let's try for the first one. So that will give you how much? How much is the contribution for J? So 3 plus 1, 4, 4 plus 1 is 5. So 5 minus 5, that will give you 5 for J. All right, so how much will be for the K? So for the K, 5 minus 2.50 minus 1.50 minus 0.15 minus 0.10. So it is 0.75. Very well done. 0.75. Okay. And finally for the L, 3 minus 0.50 minus 1.25 minus 3.50 and minus 2.5. And that will be how much? 0.70. That's it. Only remember, we do not consider the fixed on the contribution. Do not consider the fixed. All right, so if you remember the formula, sales minus variable cost, that will give you the contribution. Any question from here before we move to the next question? Anyone have any question to calculate the contribution? It's quite simple. It's nothing I'm sure have any issues to all of you. All right, very well done, Michelle. So let's go and take a break, and we'll come back after half an hour. So let's start at 8 o'clock, and we'll carry on from here. The next activity, we have activity 2. and that is for the unit cost. Let's try this question. So this question is about the unit cost. A factory produced a single product with the following budget cost: direct material, direct labor, variable overhead, and the fixed overhead. Overhead are absorbed on the machine hour basis, and it is estimated that in the next accounting period, machine hour will total 100,000. Each unit requires 2 hours of machine hour time. So every single unit need 2 hours of machine time. So obviously that means when you calculate the overhead absorption rate, when we'll calculate our overhead absorption rate, we have to make sure we multiply by 2, because every single unit, each unit need 2 hours. So the question here is calculate the cost per absorption costing and the marginal costing. So let's do that. So you can see there is two format here, but we can do in the corner. So we can write it down here, absorption costing, and we can write MC, that is marginal costing. So let's start with the direct material. So direct material will be same for both. So that is 340. So 340, 3 pound 40 is same. The next one is a direct labor. That's also variable cost. So that will be same as well. Direct labor 680 and 680. Then you have variable overhead, that will be also same. So variable overhead 1.20, 1.20. Now the question will come for the fixed overhead. Now for the MC, we'll stop here. We're not going to take the fixed overhead, but maybe we'll make 0 to make it more understandable. So now the fixed cost, we have 340,000. This is the total fixed cost, but we need per unit. We have to break down the total fixed cost into per unit. So we say total fixed cost, that is 340,000, and total machine hour is 100,000. And if we divide with that, that will give me per hour. So per hour, the overhead per machine hour. So 340, 340 divide 100, and that gives me 3.4. So 3.4 for 1 hour. And if we multiply by 2, isn't it? Multiply by 2, because every single unit need 2 hours. So that will be 6.8. Because the question said every single unit need 2 hours. So 6.8, very well done. Now this 6.8 we have, that will be only for the absorption, 6.8. And in marginal, we don't include the fixed cost. So in marginal, only the variable cost. In marginal, only the variable cost. So let's add all of this. Let's add all of this. So what we do for the absorption, 3.40, 6.80, 1.20, and we have 6.80, that will give us 18.2. 18.20, that's my cost for the absorption costing. And for the marginal, how much it will be? 11.40. For the marginal, we don't have any fixed cost, so only take the variable, and that gives us 11.40. So that's how we can identify the cost, how much is for the marginal and how much it will be for the absorption. All right, so let's move to the next question. We have maybe activity 3. Let's try that. In activity 3, MC versus AC, so marginal costing versus absorption costing per unit. The following information relates to the manufacturer of a product E during the month of December 2006. Direct material per unit 12, direct labor per unit 13.50, total variable overhead 88,000, total fixed overhead 110, number of unit 11,000. Okay, the question the same. They're asking to identify the cost for the absorption and for the marginal. uh, Fatima, if you cannot hear, so check your settings. Check your settings. So I think rest of you can hear me very well. So only the Fatima having some issue. Uh, I don't know. Maybe sometimes the device, if the settings is not very good or something, maybe it's better to rejoin. I can tell or can rejoin. Rejoin. All right. So let's try that. This question we have for the absorption and for the marginal. So you do the same way. Can everyone try that? Okay, the first one we have the direct material is same for both because both are variable cost. Direct material 12, 12. Then direct labor variable 13.50, 13.50. Total variable overhead. Now 88,000 is the variable overhead. So I have to make per unit. So 88,000 divide. Total unit is 11,000. And that gives me how much? 8. That gives me 8 per unit. So I said variable overhead 8 and 8. And finally, I have the fixed overhead. So fixed overhead, total fixed overhead is 110,000. Divide 11,000 unit. That gives me 10. So the 10 will only come for the absorption costing, not for the marginal. And if I added all of this, that will give me the total cost for both absorption and for the marginal. So let's have a look. If you add all of this, how much it is. So for the absorption is 43.50, and for the marginal that will be less 10, so that will be 33.50, because in marginal we don't have any fixed cost. I'm sure now all of you have some idea the difference between the absorption costing and the marginal costing. Now maybe the next question you're going to see, what is the impact on the profit? So let's have a look. What is the impact on the profit? We'll do the next activity or next exercise. We'll see what we have here. So the profit statement we have now, obviously the profit statement could be differ sometimes based on the requirement, but let's have a look if we can do this question together in the same page. So let me see if we can see all of that. All right, let's read the question first. It says marginal costing profit statement. Now let me tell you exactly like why there is a different level of profit for the absorption costing and the marginal costing. So let's say if we have the absorption costing and if we have the marginal costing, the profit will not be same. it will be same if there is no opening inventory and if there is no closing inventory. Remember that if the question said there is no opening inventory and if there is no closing inventory, doesn't matter which costing method we use, the profit will be same. But problem will happen when the opening inventory and the closing inventory is different, it's not same. So and there is opening and the closing inventory, so the profit could go up and down. I'll show you how. For example, let's say we have a sale £100 and £100 both method. Now from the sale, what we do, we minus cost of sales, cost of sale. Now in the cost of sale we have few things. We have opening inventory, we have purchase, and we have closing inventory. And the issue is happen when we have opening and the closing inventory, because the inventory valuation depends what type of method we use. Now for example, under the absorption method, our cost per unit is 20. Under the marginal method, the cost per unit is 15, because in the absorption we have a fixed cost, in the marginal we don't have a fixed cost. So the cost per unit of the absorption will be higher than the marginal. It's the common sense. So let's have a look how it is differ. For example, let's say my opening inventory is 20 and my purchase is 30 and my closing inventory is 10. So what will happen? Opening inventory plus purchase less closing inventory. So 20 plus 30 is 50 minus 10. So that gives me 40. If I minus the 40 from the cell, that gives me profit. Profit is 60. And when you do the opening inventory for the marginal costing, so this one will be lower because I have to multiply with the lower cost of unit, isn't it? So let's say if I multiply, and if it is 15 and if it is 30, and let's say 13 plus 15 is 45, and let's say it is 10. So we have, let's finish the advanced absorption costing first, then we'll move to the marginal. So let's try to understand this side first. Now let's say as soon as I have more closing inventory, the profit figure will be changed. I want all of you to understand it's all about the opening and the closing inventory. If I change the closing inventory figure, I want all of you to understand how the profit could be increased. Let's say the closing inventory is not 10, the closing inventory is 20. So if the closing inventory is more, I'm sure all of you know what is closing inventory. The closing inventory is the amount the inventory couldn't sold. It's left over on the warehouse. So if I make 100 unit and if I can sell only 50, so another 50 left in the warehouse, we called it closing inventory. So if my closing inventory is 20, you can see now 20 plus 30 is 50 and minus 20, that will gives me 30. So now my profit will be 70. So if my closing inventory increase, my profit is also increasing. So the main point here is if my closing inventory increase, my profit figure will be also increase. So we'll do some example, we'll be understanding more. So more important thing is if there is no opening inventory, if there is a no closing inventory, doesn't matter which method I use, absorption or marginal, the profit remains same. But if there is an opening inventory and if there is a closing inventory, then the profit figure will go up and down. If there is a more closing inventory, the profit will be more. Do not think from the other point of view, like if there is a more closing inventory, the cost will be more, then profit will be less. No, the closing inventory we minus under the cost of sales. So on the cost of sales, we have a formula. The formula is opening inventory plus purchase less closing inventory. So you minus the closing inventory from the cost. So if I have a more closing inventory, actually it is not increasing the cost, it is decreasing the cost. Anyway, so let's do this example, activity 4. Let's have a look how does it work. So the question here is marginal costing profit statement. So you have to see only marginal. SC, the catering has established the following budgeted annual sales and the cost information meal types, standard and the vegetarian. We have a two type of meals. One is standard and one is vegetarian. So let's have a look. So we have sold 130,000 meal for standard, vegetarian 200,000. Staff require, so 30 to 50, we have 6,000. Sales, this is my sales, this is my direct material, this is my direct labor 260, for the vegetarian 400, and for the labor we have 260 and 300. The fixed costs contributable to the standard and the vegetarian meals are budgeted to be 212. So this basically that's my fixed cost. There is no problem for that. Let's have a look at the template. What is the template here? Selling price per meal. So we can get this one. It's not a big deal. Selling price per meal, because we have a total revenue, and if we divide with the number of meal, that will give me per meal, isn't it? It's not difficult. Then variable cost. We have a direct material, we have a direct labor, and we have a variable overhead. So there is three costs we have: direct material, direct labor, and the variable overhead. Then we have a contribution per unit. We know the formula: sales minus variable cost equal the contribution. Then we have a sales volume. This is the volume. Volume means the unit. We have sold 130,000 meal for the standard. We have sold 200,000 for the vegetarian. Total contribution, if I multiply with the 1 unit contribution with the number of unit, that will give me the total contribution. After that, we have a fixed cost, that is 212. And if I minus that from the contribution, that will give me the profit. So let's do that together. The first one we're going to do selling price per mil. Can we get that? Selling price per mil. How much is the selling price per mil? So total revenue is 1040,000 for the standard, and total meal is 130,000. If I divide, that will give me per meal, isn't it? 8. And the next one will do the same way. So 1500,000 divide 200,000, and that will give me 7.50. All right, so selling price per meal is standard is 8, and for the vegetarian is 7.5. Then we have to calculate the cost, the variable cost, direct material. The total is 6 and 468. So 468,000 for how many meal? 130,000 meal. If I divide, that will give me the direct material per meal, isn't it? So that is 3.6. 3.6. Thank you, Alicia. Thank you, one. So 3.60. Then the same way you can do for the vegetarian. Can you give me the vegetarian, how much it is? So that will be 600,000 divide 200,000. That should be 3. The direct labor, can you do the direct labor the same way? 260 over 130. So that's 2. Thank you, Fatima. Then we have the same thing for that, for our vegetarian. So we'll do direct labor 400,000 over 200,000. That will give you 2 again. Then we have the variable overhead 260 divide 130,000. That will give me the per meal overhead cost. So that is 2. And for the vegetarian, we'll do the same way. So that will have 300,000 divide 200,000 per meal, and that will give us 1.5. Very well done, Aya. Very well done, Alicia. Very good, D. That's 1.5. All right, so contribution per unit. Can we get the contribution per unit now? We have all this variable cost, that is material, labor, and the overhead. Now all you need to do, you need to minus all of this from the cell, and that will give us contribution per unit. So how much is the contribution per unit? 40 pence. Okay, 0 0.4. This is for our standard. Can we have the same way for the vegetarian? That is 1. Very well done. Now we have to do for the sales volume unit. So how many unit we have sold? We sold 130,000 unit for standard, 130,000 unit for standard, and 200,000 for vegetarian. And total contribution. So this times this and this time this will give you the total contribution. Can we have the total contribution for the standard? 52 52,000. Very well done, Fatima. Very well done, Adel. And the next one for the vegetarian, how much is the total contribution? So 200,000 times 1 should be 200,000. So 200,000. Now if I added this to 52 plus 200,000, that will give me the total contribution from both standard and the vegetarian. So that will be 252,000. Very good, Sidora. Then we minus the fixed cost, less the fixed cost. And the question already said to us the fixed cost is 212,000. So minus 212,000, 212,000, and that will give us the profit. So can you give me the profit figure? Very good. This is 40,000. That's my profit. All right. So that's the question for that. All right. That's the solution for this activity. If you have any question, you can ask me now, or we can move to the next exercise. So let's move on to our next exercise, activity 5. In this activity, they're asking CPL is considering what the effect would be of costing if products under the marginal costing principle instead of full costing, that is absorption costing principle, that is currently follow. So now currently the company following the absorption costing, and the company want to know what happened if I started with the marginal costing, what will be the impact, what will be the difference. So they want to find it out. That the following information relates to one of the company's product: selling price, prime cost means all the direct cost. If you remember that, prime cost means all the direct cost. So all the direct costs together, we called it prime cost. Then we have variable production overhead, that is 3, and we have a budgeted fixed production overhead, that is 30,000 per month, budgeted production 15,000, budgeted sell 12,000, and the opening inventory 2,000 unit. Okay, so let's have a look how we calculate that. The first one, they said unit per cost for marginal. That's very easy, you already done so many times. Unit per, then calculate the profit per unit. So per unit profit under the full cost, so that is absorption costing, full absorption costing. Then we have complete the table below to produce a statement of profit and loss. So prepare the profit and loss statement, okay, and profit and loss statement again, that is from the absorption, that's from the marginal, okay. So let's do that. So we can write it down, this information in the corner, so that we can do it together. So let's write it down. The selling price 12 pound, then prime cost 4 pound, variable production overhead 3 pound, budgeted fixed production overhead fixed overhead, that is 30,000 per month, 30,000 per month, then budgeted production 15,000 per month, budgeted sell 12 per month, opening inventory 2000. So you can see here, uh, we have make 15 and we sold 12. So 3000 we have a closing inventory from here, isn't it? We have made 15,000 unit, we have sold 12, so 3 is left, and we have opening inventory 2000 from the last period. So whatever is a closing for this period is the opening for the next period. So we have to be remember that. And the question said, like, before they used to use the marginal costing, and now they want to see what will happen. Before they used to use the absorption costing, and now they want to use the marginal costing. There are a few information here. So let's try to do this question everyone together. So hopefully if you understand that, we'll have a very good understanding of marginal and the absorption costing. Let's start with the first one. Selling price per unit, that is 12 under the marginal costing and 12 under the absorption costing. Same thing, selling price is same anyway. The next one is a prime cost. The prime cost is a 4. So prime cost is 4. And we have obviously like the marginal cost per unit. So that is 4 plus 3, isn't it? Marginal cost per unit, that is 4 plus 3. Marginal cost means all the variable cost. All variable cost. That will be our 7. Then variable production cost per unit. Variable production cost per unit 3. So it's at 3. Then marginal cost per unit, this is 7. So 3 plus 4 is 7. This is the 7 here, you can see it. It's the same thing. So you don't have to calculate again like direct material, direct labor, because you know the total variable cost is 7 anyway. So the contribution 7 from the 12, the contribution is 5 per unit. But here we have to add the fixed cost as well. So the fixed cost, the question said 30,000 per month, and the budgeted production is 15,000. Remember, the fixed cost you always divide with the budgeted production, not with the unit you have sold. Never divide with the unit sold, because unit sold can be anything, but you have to see how many unit you have make. You can make a million but you can sell only 1000, so you need to see how many unit you made. So the cost will be determined based on the production. So the cost will be determined how many unit you have make rather than how many you sold. So you have to divide with the number of unit you have produced. So that is 15. So that's give you 2. So your full cost will be 2 plus 7, 9. And if I minus it from the 12, my profit will be 3. So under the absorption costing, the contribution is 5. Under the marginal costing, the profit is 3. So when we do the marginal costing, we called it contribution. When you do the absorption costing, we called it profit. All right, so this is the basic thing. This one you already know. Now we move to prepare the profit statement, and we'll see what is the impact when you prepare the profit statement under both methods. So let's have a look. First, we'll do under the absorption costing method. The sales. Selling unit is 12,000. We have sold 12,000 unit. 12,000 units. So 12,000 times per unit selling price is 12. So per unit selling price is 12. So 12,000 times 12. How much it will be? 12,000 times 12. So that will give us the total sales. So 144. Very well done. 144,000. Now after that we will do the cost of sales, and the cost of sales have a formula. The formula is opening inventory, then we have a production cost minus closing inventory. So the opening inventory, do you remember the opening inventory? How many unit? It was 2000 unit, and the marginal cost was 7. We are doing the marginal cost. So opening inventory 2000 times 7, that will give us 14,000. Then we have the production cost. We make 15,000 unit, so 15,000 times 7, that will give you the production cost total. So how much it is? 105. And the closing inventory. So how many unit we have on the closing inventory? So we already had, so you have to understand this thing. So we had 2000 at the beginning. So opening from the last period, we had 2000. Then for this period, I make production of 15,000. So I add 15,000. So total, I have 17,000 unit, isn't it? And from 17,000 unit, I have sold how many unit? 12. Sold 12,000 unit. So my closing is 5,000 unit. Remember that your closing is not 3. Don't just look at here like, oh, I have make 15 and I have sold 12. That means I have 3 left. No. Remember that you already had something from the last period. So 5,000 is the closing times 7. That gives you 35,000. So can we have now cost of sales? So we have 14,000 plus 105 minus 35,000. That will give you the cost of sales. Opening inventory plus production less closing inventory. That will give you the cost of sales, and that is 84,000. Very well done. 84,000. Very well done, Theodora. Very well done, Alicia. Now we have the contribution. So cost of sales minus the sales, that will give us the contribution. So can we have the contribution? 144 minus 84, that will give us the contribution, isn't it? 60,000. Very well done, contribution. And finally, you have to consider the fixed cost. And the fixed cost is 30,000 per month. So we said fixed cost is 30,000. So if we minus the fixed cost from the contribution, that will give us the profit, and that is 30,000. This is the profit statement under the marginal costing method. Anyone have any question from here so far? Before I move to the absorption, if you have any question, just let me know. I can explain more. All right, that's fine. The closing inventory, Vinal, of course I can. So the closing inventory, the question said we have 2000 at the beginning. So 2000 was the opening, and we make another 15,000, the question said. So I added 15. So 2000 plus 15, that gives me the total unit 17,000. And from the 17, I have sold 12,000. So if I sold 12,000, 5,000 is still I have on my stock. Got it? All right, very good. So let's move on to the next one then. So let's move on. You're welcome, Vinod. So let's move on to our next point. So that will be our absorption. So let's have a look. So let's move on. Now we move to the absorption costing. In the absorption, we do the same way, but this time we multiply with 9, not with the 7, because the fixed cost will be included. So sales amount will be same, 144,000. So there will be no changes of that. Cost of sales, opening inventory 2,000, but this time multiply by 9, not with 7. Production 15,000, multiply with 9. And the closing 5,000 will multiply with 9. So all of this will give us the cost. So can I have the figure for that? 2,000 times 9, that should be 18,000. Then we have 15,000 times 9, that will give us 135. 135. And 5,000 times 9, that's 45,000. All right, so if we have the cost of sales now, so opening plus production less closing, that will give us the cost of sales. So that is 108. Okay, 108,000. Very good. And if I minus it from the sale, the cost of sales, that will give us the profit. And the profit will be how much? 36,000. All right, that's my profit. So obviously, like you can see the difference. So under the absorption costing, under the marginal costing, under the MC, the profit was 30,000, and under the absorption costing, the profit is 36,000. You see the difference of 6,000. Why? The difference of 6,000 of the profit, you can see it very clearly because of the opening and the closing inventory. Now, obviously, if there is no opening and the no closing inventory, the profit will be same. You can see this 5,000, under the absorption, I multiply with 7, isn't it? So that gives me 35,000. And under the absorption, this 5,000 I multiply with 9. That gives me 45,000. So let me show you maybe a little bit here. This is a little bit important to understand how the differences come. So we can write it down here. So under the absorption costing, the opening inventory, so let's say marginal and absorption. Opening inventory was 14,000, and under the absorption it is 18,000, because we multiply, here is 7, here is 9. Then the closing inventory under the absorption, under the margin, it is 35,000, and under the absorption is 45,000. So you can see here marginal and the absorption. So from 14 to 18, so opening inventory increase only 4,000, and 35 to 45 it is increased to 10,000 the closing inventory. And the closing inventory actually we minus from the cost of sales, so that will reduce the cost. So 10 and 4, the difference is ultimately how much? 6,000. And that's why this profit is differ absorption and marginal 6,000. If there is a no opening inventory, if there is no closing inventory, the absorption and the marginal will give you same profit. All right, so we have a number E. So explain why the two profit figure differ by selecting the correct words from the brackets in the statement below. Okay, the two profit figure differ by 6,000. This one you already know, because under the absorption costing is increase the valuation of the inventory, because we multiply by 9 on the absorption costing, so the closing inventory is more, so increase the valuation in the month. Of course it is higher than the increase under marginal costing, because in marginal costing it is only 35, but absorption costing 45, because here we multiply by 7 under MC, and here we multiply by 9 under absorption costing. The reason is in MC there is no fixed cost, and absorption there is a fixed cost, that's why it is more. So I hope you understand actually the logic behind why the absorption costing showing the more profit and marginal less. What is the reason the unit cost per unit under the absorption costing is higher than the marginal? So all you have to remember, in the inside of the product, if I use the absorption costing method, there is a fixed cost. If I use the marginal costing method, there is no fixed cost. This is the main basic understanding. All right, any question from here from anyone? No, that's very good. So let's move on. So we have done so far 3 chapter. Um, I think that is enough for today. And we have 2 more chapter. I think we have done up to 12. So 13, 14, or 15. I'm not sure how many chapter. It could be 14 or 15, but we'll do next week anyway. So the next chapter will be that we're going to do short-term decision making. Maybe the next chapter will be long-term decision making. Yeah. So 2 chapter left. Yes, Vinal. Yeah. So we'll do it next 2 chapter, chapter 14 and 15 next week, and hopefully we'll be absolutely fine. Then after the next week we'll do a revision. On that revision we're going to see exactly what type of question we're going to see in the exam. So we'll bring a past paper, the recent exam question, and we'll practice on that, so that we'll be seeing what type of question will become in the exam, and how can we answer. We'll solve the whole question on that day. So the next week we'll complete the book. Week after we will do the revision on a past paper, and then we'll do the final exam. So I would say, if you haven't started your practice yet, so you start from now. If you have the question bank, you start from there practicing. If not, practice from the book. End of the chapter you have a test you're learning, practice that, and I'll send you some more practice question maybe tonight or tomorrow, so that you can practice more and more. It's better to have your question bank with you, but if you don't have it, but still I'll send you some practice question by email to all of you. You can practice from there. I will send you some mock type of question as well, so you can practice that. I'll send the solution so that you can check your answer with that. Top of that, you can log into your my AAT account. From there you have a 2 practice question, you can practice that as well. So my main point is, if you haven't started the practice, do it from now, because in 3 weeks time you will have your final exam. So the next week will be the revision, then week after, sorry, next week will be the class, week after will be the revision, and after that you will do your exam. So you have to be make yourself ready in 3 weeks time for the exam. All right, so if you're happy with that, we'll stop here today, and we will start from chapter number 14 next week.